Hey guys, welcome to another video. We're going to move on to the next topic. So I hope this video really does help you a lot. So we're going to look at cash flow statements, and this is the introduction to cash flow statements. This is the format of it and the notes that we require to the cash flow statement. So let's get into it. It's very important to understand that the cash flow statement is only for grade 12s. You're not going to bump into this or deal with this as a grade 10 or a grade 11 student. This is a matric topic. And this is basically the format of a cash flow statement. The cash flow statement is split into 4 parts. If you remember these 4 headings and you think about it logically, you're going to be fine. So part A is going to be the cash flow from operating activities. This has cash generated. For this cash generated, you obtain that amount from this first note. So the reconciliation between profit before tax and cash generated from operations, where you have your profit before tax first, then you add up all your depreciations for all your assets, you add up your interest expense, and then you get your total profit before changes in working capital. Then you'll have your changes in working capital. Now, your changes in working capital is the word states itself, it's a change. So what happens with inventory during the beginning of the year? We're comparing the amount of inventory we had in the beginning of the year to the inventory we had at the end. Very important. When an asset increases, always, even if you don't have time to think about it logically and you decide to cram this, when an asset increases because inventory and trade receivables are an asset, that is always going to be seen as an outflow. So let's look at it as inventory. When our inventory levels, our stock levels increase, it means we bought more stock from our supplier, money went out, so it is an outflow of cash. And then if you know that for inventory, same thing applies for trade and other receivables because it's also an asset. When a liability increases, because trade and other payables is a liability, it's a current liability under the balance sheet. When a liability increases, it is an inflow. And obviously, vice versa to that would be an outflow. So when a liability decreases, it is an outflow. I'm going to make a simple example with a loan because a loan is a non-current liability. Because why is it non-current? A loan is expected to be paid over a period of a number of years. It's not paid over within 12 months. That would be a short-term loan, which you won't do in grade 12. That's something you do when you get to varsity, if you decide to take accounting further. But very important, when you take out a loan and you go to the bank and you increase your loan, money comes in because you borrowed money, it's an inflow. But the moment your loan gets less, if you first took out 500,000 Rand from the bank, and then at the end of the month, you now have 450,000 Rand capital left of your loan. You've paid 50,000, and when you pay, it's an outflow. Money's leaving the business, and therefore we refer to that as an outflow. So whenever a liability increases, it's an inflow. When it decreases, it's an outflow. And whenever an asset increases, it's an outflow. When it decreases, it's an inflow. Because when your inventory decreases, it means you've sold it and money comes in when you've sold inventory. It is very important that you have to state that is there an increase or a decrease in your trade and other receivables and payables. And I made a mistake. You're also supposed to state also here if there was an increase or decrease in your inventory. And very important when you're stating your amounts here, if, for example, your inventory increased, it's an outflow. Therefore, the amount that you indicate here would be in brackets. Because whenever money is leaving our business, we account for it as, or put brackets or a minus sign next to it, depending on whatever works best for you. But you must indicate that money is leaving the business and not entering. So very important you state that. So the amount that you obtain here from your generated income, which you're going to obtain from taking this profit before changes in working capital, plus minus whatever the total amount here for the changes in working in capital is, and then you get your generated income. This generated income goes straight here. You pluck it right there. It's a copy and paste amount. Whether it's in brackets or it's positive, you copy and paste it to that portion of the cash flow statement. Next thing we look at is these are the things that fall under there. Very important to understand whenever you're dealing with a cash flow statement, you use T accounts. Because if you're dealing with an asset, like a fixed asset, we know assets increase on the debit side. Everything that increases the asset goes on the debit side. Everything that decreases the asset on the credit side. You always have to use T accounts to be able to maneuver through cash flow statements. Cash flow statements in Matric are extremely easy, and they're about 25 marks to 30 marks, and you can score the full mark allocation on them. So they're very simple. So that's that section. Then we move on to the second section, which is the cash flow from operating activities. This one is straightforward. This is very important when we're dealing with the cash flow. Something I forgot to state in the beginning of this video is that everything that goes under here is cash related. Depreciation, movement on movement on the provision of bad debts, all these things, and bad debts itself do not go here because they are non-cash items. What goes into the statement are cash items only. And the purpose why depreciation is accounted for in this note is because it's a non-cash item, and in the income statement, it's an expense, meaning we subtract it. Here we add it back, and when we add and subtract something, we cancel it out because its net effect becomes zero. So don't confuse. This is what confuses people. If you understand that whatever and the only thing that goes into the statement is cash related items, you're going to be fine and you're going to nail this topic. So don't make the mistake. So the cash flow from operating activities, your purchase of tangible assets or your fixed asset, the amount, the straight up amount that you paid for this tangible asset for that specific current financial year. If you bought a new vehicle and it cost you 150,000 Rand, you place 150,000, but in brackets because money's leaving the business because you paid and you bought something. When you sell this asset, let's say you buy the vehicle and you later sell it within that same financial year, and you sell it for 120,000 because of some depreciation that has been accounted for, it's very important that you state your 120,000, but this is a positive amount, so no brackets because money's coming in. And then it's very important to account for an increase or decrease in fixed deposit. If you increase your fixed deposit, a fixed deposit is an asset. When an asset increases, what did I say? It is an outflow. So the moment you have increase, immediately brackets. The moment it's a decrease, immediately no brackets. So you must remember that. If it means cram it, then you cram it, because there's basically 2 hours in accounting isn't enough to waste your time trying to, remember everything. Sometimes you have to cram to save your life at this point. Next part is part C, the cash flow from financing activities. This straight financing, what you require to finance your business is loans, or when you are you provide shares, you issue out shares in your company to external people, so to shareholders and potential investors, you issue out shares. Those are ways in which you can finance your business, especially since we're dealing with companies in Matric. We issue out shares. If you were dealing with a partnership and a sole proprietorship, it would strictly have been a loan, or partners contribute a specific amount to be able to finance the business. But here we look at a loan, because there's the loan, an increase or decrease in a loan. And as I had stated, a loan is a liability and an increase in a liability is an inflow. When you sell out, the proceeds from your issuing of your shares, so when you issue shares and you sell shares to external people and outside of the company, it's very important you understand that this is going to be an inflow because money is going to come into your business. But it's very important that this is your first issue, because we have two different kinds of issues. We have a primary issue and a secondary issue. And a primary issue is when the company is issuing shares for the first time to the public. And then a secondary issue is if the company's already issued out these shares to a shareholder, the shareholder no longer wants to be a shareholder in that company, so they sell it to another shareholder, and that is referred to as a secondary issue. And in that instance, if they tell you that a shareholder sold the shares, you ignore. This does not go there. The only thing that goes here is a primary issue, and it's for the new shares that you are issuing. So if you've had a company for 10 years and this year you issue out 10,000 shares and 10,000 shares at 1 Rand each, meaning 10,000 Rand you're going to receive, you place 10,000 Rand here. If it was a secondary issue of 10,000, you ignore, because a secondary issue does not affect the company. Very important, don't fall for the trick. Then the buyback of the shares, it's the share capital amount in your retained earnings. Remember, for that very first topic that I said you're going to find under accounting by Abongi, I stated that in that you're going to find that first topic there. And in that topic, when in your share capital note, you have your average price, right? When it comes to a share buyback. And in your retained earnings note, you have an above average price. You take the two amounts, you add them together, meaning the buyback of shares in the cash flow statement is the total amount plus, meaning your average price, plus your above average price, times it by the number of shares you've bought back and you get amount. But it's in brackets because when you're buying something back, money leaves the business. Don't confuse that. The last section is section D, which is your net change in cash and cash equivalent. The way I was taught when I was in matric, my accounting teacher says, whenever you get to section D, start from the bottom up. So your cash and cash equivalent is going to have, obviously, your cash and cash equivalent from your section. You're going to find that in your balance sheet. And you must always look out if there's a bank overdraft that's present. So if you look down under your current liabilities and you realize that there's a bank overdraft that's present, you have to account for it here. So if your bank overdraft is 5,000, so it's negative 5,000. And if your cash and cash equivalent is 2,000, it's negative 5,000 plus 2,000 and you get a negative 3. Then you do the same thing for the beginning of the year because they usually provide you 2 years to compare. So this would be the end of the year, maybe 2025, and this would be a 2024 year. You do the same thing, check if there's a bank overdraft here. So I'm going to make a simple example. If you have your bank overdraft to be negative 5,000 Rand and your cash and cash equivalent amount is positive 2,000, this is how it would look. So in brackets here, you would have your negative 3,000 Rand in brackets, right? Then you have the same thing. So this maybe is the 2025 year. Oops, sorry. This becomes the 2024 year. This way, if you have a negative 1,000 Rand for your bank overdraft and your cash and cash equivalent in the beginning of the year was 7,000 Rand, oopsie, you're going to have this is going to be tough, wait, 6,000 Rand. Oh, no, that looks like a 6, but okay. Oh, okay, you get the idea, 6,000 Rand. So whenever you go up, this line, I drew this line on purpose. Whenever you go up, the sign changes. Your bottom sign remains the same. So this remains negative 3,000. But this is a positive. So we have an invisible plus sign here. So when you move up, it would be negative 3,000, negative 6,000. And the amount that you expect to get here would be a negative 9,000 Rand. So that's how you move up. So then it's straightforward that when you're moving from negative 9,000 here, you'd say negative 9,000 plus 6,000 gives you negative 3. Whenever you go up, the sign changes. Very important, this amount here should total to the addition of your A, plus your B plus your C, meaning your total amounts that you find here should equal to this negative 9,000 Rand or whatever the amount is based on the question you provided. And the last part is we're going to look at the last notes. I just explained this. Whenever this is a second type of note that relates to your cash flow statement, always work from down up. That's the easiest thing you'll ever do for yourself. When you have this 9,000, this becomes your balancing figure for both A, B, and C of your part of your statement. Your dividends paid, right? This is the format for your dividends paid. All the other formats of other notes are extremely easy. Your taxation paid, you have all that. And your tangible assets, you just add up your land, your vehicle, your equipment, and that would be your tangible assets. Hope this video was very helpful. Please don't forget to like, comment, share, and subscribe, and see you on the next video. Thank you.